Good morning. It is Monday, September the 22nd, 2025. Hope everyone had a nice weekend. I feel a little lighter today. I received a much needed haircut. So that feels good. Another beautiful weekend here in Charleston. My son had his little pre-K class, did a little trash pickup at the beach Saturday morning. Then my daughter had a soccer game, and then in terms of like our activities and commitments, like we were pretty much had those all wrapped up by Saturday morning. So it was really nice. Just a nice relaxing weekend. So we hope you had a nice weekend as well. All right, big news last week, of course, is the Federal Reserve finally cutting interest rates. So as expected, consensus that is, was the 0.25% decline in the Fed funds rate. All right, so down 25 basis points. The Fed was calling it a risk management cut, which I would agree with. You cannot deny that. Just looking at the employment data, okay, the private non-farm payrolls figures have really slowed. All right, and even throughout these reviews that we just completed week 4 of reviews last week, just hearing from many of you just what the employment market looks like, it really seems like it has slowed. So yeah, I think probably a good idea that the Fed is finally cutting rates. Now the market is pricing in 2 more cuts between now and the end of the year. So we'll see how that plays out. The Fed, the Fed Chair Powell, like he always says, you're going to remain data dependent as they try to fulfill their dual mandate of employment and controlling inflation. So with that being said, a question that we've had come up a lot, and we've discussed it a little bit on these Monday videos as well, but just, hey, like when the Fed cuts rates, does that mean that mortgage rates are also going to decline? All right, and so I thought it was worth sharing. I came across some actual data to quantify, to kind of give a better answer to that question in terms of a percentage. So Dimensional did a nice study, and so they looked back a number of decades, through today, and again, because just for those of you that don't know, like the Fed controls the short end of the curve. Okay, so like the overnight lending rate, which is closely tied for many like HELOCs, so home equity line of credits. Like when the Fed cuts rates, for like a HELOC and some other borrowing vehicles. Like that rate adjusts almost instantly. Okay, when the Fed cuts rates, it's also going to banks, like the yield you might receive in like a high yield savings account, like those will go down very quickly as well. Okay, but mortgages are while not exactly tied to like the 10-year Treasury, it's kind of like the best place to start. Okay, so just the U.S. 10-year Treasury. All right, and so when the Fed reduces interest rates or hikes interest rates, like how mortgages respond, it's more based on the 10-year Treasury. All right, so tying it back to this piece of research. All right, so they look back, all the Fed hikes and cuts, and then what the 10-year yield, what the Treasury did in the month after the cut or the interest rate increase. Okay, so obviously we're in a cutting cycle, so I'm going to leave off what happens when the Fed is hiking rates. But so when cutting, like what happened last week, all right, so the 10-year yield historically has declined in the month following a rate cut 64% of the time. All right, so maybe a little bit less than 2/3 of the time. You'll also see the 10-year yield come down in the following month. All right, because again, it doesn't happen overnight because the 10-year is more based on supply and demand. All right, meaning 36% of the time, even when the Fed cuts, the 10-year Treasury can increase. All right, and again, we've been over why, that Fed cuts, that can potentially be inflationary longer term, right? And that's the balance that the Fed's trying to figure out as well. So I don't know. I thought just kind of rather than just these blanket statements. The mortgage rates don't always decline when the Fed cuts. Yeah, actually having some data. So it's roughly 2/3. Two-thirds of the time. On this Fed cut, we could expect the 10-year to go down, but that leaves another third where it won't. So I don't know. I thought it might be worth sharing. So with that being said, here we're kicking off week 5 of reviews this morning. But it's been so wonderful catching up with many of you. So looking forward to another good week here ahead. Questions, comments, concerns, please don't hesitate to reach out to our team. And we hope you have a great week. Thanks.